Hello, hi guys. How are you? Hope you people are doing well. Even I am fantastic. In today's class, we will be discussing SA 540, SA 550, SA 560, 570 and 580. All these five standards will be covering in today's class. Now, basically, if you see all these standards, they are related to certain areas where there will be significant risks. Now, auditor, while identifying risk of material misstatement, the risk will occur because of these areas. If you see SA 540, there will be a significant risk that will arise because of estimates. SA 540 deals with auditing accounting estimates, and in the same way there will also be a significant risk with because of related party transactions. In the same way, subsequent events and with respect to going concern SA 570. So all these areas there will be significant risk that will be involved. So in these areas, since there is a significant risk, the institute has given separate standards covering each of this area. Okay, so from that series we will be covering SA 540 first, which deals with auditing accounting estimates and fair value accounting estimates. Now, what is this accounting estimates? Before that, first of all, the objective of SA 540. What is the objective of SA 540? To enable the auditor to obtain sufficient appropriate audit evidence about what? About whether accounting estimates, including fair value accounting estimates, are reasonable. Now, who will make these accounting estimates and fair value accounting estimates? Management will make. Now, auditor has to evaluate whether these estimates that the management has made are reasonable or not, and related disclosures in the financial statements are adequate. Basically, with respect to this estimates, disclosures like assumptions used, data that has been used, okay, and the subjectivity involved, all this will be disclosed. So whether the disclosures that has been made with respect to the estimates is adequate for the purpose or not, even that auditor has to verify. Okay, so this is the objective as per SA 540. Now we will see what is meant by accounting estimate. See, the name itself suggests it is an estimation made by management. Now, when will you make an estimate? When actual figures are not available, okay, you will make estimate. Most of the times, estimate will be with respect to future only. Best example for accounting estimate, provision for doubtful debts. This is the best example. Okay, you are having some debtors and you are expecting that some of the balance of the debtor will not be realized. So you have to make a provision for this doubtful debts, which is an estimate. You don't know how much will be the actual amount of default from the debtors. You have to estimate the default amount. So this is a accounting estimate. Let us see the actual definition. An approximation. Okay, accounting estimate will always be approximate only, it will not be accurate, of monetary amount in the absence of precise means of measurement. Since actual amount is not available, you are making a estimation, approximation of monetary amount. Hope that is clear. Next, fair value accounting estimate. See, fair value accounting estimate is also a type of accounting estimate, but see, it is a type of accounting estimate which involves estimating the price at which asset could be sold or liability could be settled in an ordinary transaction between market participants. Okay, if you take this asset and sell it in the market, actually how much you realize, that will be known as fair value accounting estimate. Okay, between actual market participants, what is the exchange value, that will become fair value accounting estimate. Now, if you see in India, there are various items that require fair value accounting estimate. First of all, financial instruments, assets held for sale, and in case of business combination, you will take into the assets in your book at fair value. Not only other assets, even also liabilities and share based payments. All these are examples for fair value accounting estimates. We will also see that in the next slide. See, certain examples for accounting estimates and fair value accounting estimates. Now, if you see for accounting estimates, allowance for doubtful debts, warranty obligation, depreciation method or asset life, inventory obsolescence, outcome of long-term contracts. All these are accounting estimates. Next, fair value accounting estimates. Complex financial instruments, share-based payments, assets acquired under business combination, property equipment held for disposal, transactions involving exchange of assets or liabilities. These are examples of fair value accounting estimates. Okay. So I hope now you understood what is accounting estimates, what is fair value accounting estimate. Now there is a concept of estimation uncertainty. This estimation uncertainty arises when you make accounting estimates. Now let me tell you what is this. You have estimated the provision for doubtful debt as 1 crore, but actually the debts that were not given by the debtors, okay, the actual debts that have been written off were, let's say, 1.5 crore. So now if you see, there is a difference between the estimate and the actual amount that has arisen. This difference is there na, it will be known as estimation uncertainty. Hope that is clear. And always estimation uncertainty will be there in case of accounting estimates or fair value accounting estimates. See, the susceptibility of an accounting estimate and related disclosure to an inherent lack of precision. Precision means accuracy. Okay, lack of accuracy in accounting estimates is known as estimation uncertainty. Okay, in its measurement. Next, degree of estimation uncertainty. Basically, if you see, there are various factors that will influence the degree of estimation uncertainty. Okay, how much estimation uncertainty will be there? Okay, whether estimation uncertainty will be high, low, medium. Okay, how much it will be there? That will be impacted by various factors. We will see that. Information available to management for making an accounting estimate varies widely. Okay, the information that is available to the management for making accounting estimates varies, and this affects the degree of estimation uncertainty, which in turn affects risk of material misstatement of accounting estimate. Okay, risk of material misstatement in accounting estimate means the risk that accounting estimate might turn to be wrong, might turn to be misstated. Okay, this risk in accounting estimate will increase because of degree of estimation uncertainty. Okay, if there is high degree of estimation uncertainty, then there is high risk of material misstatement in accounting estimate. Okay, hope you understood. Now, factors that will influence degree of estimation uncertainty. There are various factors that will influence the degree of estimation uncertainty. First of all, nature of accounting estimate. Okay, the type of accounting estimate that you are making. Let's say, for example, the accounting estimate that you are making is with respect to depreciation. Now, with respect to depreciation, you will mostly use the SLM or WDV, that is widely accepted method, and more or less the actual useful life or the actual amount of depreciation will also be more or less the same. Whereas if you are making estimation with respect to doubtful debts, in such a situation, in case of doubtful debts, you don't know, you might estimate that 1 crore might be the doubtful debt. Okay, 1 crore might be the loss that we might incur, so you will make a provision for 1 crore, but you don't know, actually even some more debtors are also not giving you the money. Here this estimation is dependent on external factor, so there will be high estimation uncertainty with respect to doubtful debts when compared to estimation uncertainty in depreciation. So nature of accounting estimate will influence the degree of estimation uncertainty. Next, sensitivity of estimate to changes in assumption. See, for making estimate, you will make various assumption. If slight change in assumption, if you make a slight change in assumption, how much change in estimation will occur. This aspect will also influence the degree of estimation uncertainty. Okay, the sensitivity of accounting estimate to the changes in assumption. Next, subjectivity of the assumptions used for making the accounting estimate. Subjectivity means, I have already explained you about this concept of subjectivity. Okay, subjectivity means one's emotions. Okay, if assumptions or involves subjective decisions, then there will be high estimation uncertainty. Like for example, I might think that this asset will be used for 5 years. Another person might think that this will be used for 10 years. Another person might think that we will use this asset for 20 years. So if you see here in this estimation of depreciation, each person is thinking differently. That is known as a subjectivity, which will vary from person to person. Next, availability of generally accepted method used for making the accounting estimate. Okay, if generally accepted method is available, then degree of estimation uncertainty will be less. Next, length of forecast period. Okay, for how much period you are estimating. If it is less period, then estimation uncertainty will be less. If it is much period, okay, longer period is covered, estimation uncertainty will be high. Okay. Next, examples of situation in which there will be low estimation uncertainty and high estimation uncertainty. See, low estimation uncertainty. If estimates are made frequently, then management will acquire experience, so estimation uncertainty will be less. Data is readily available. Method prescribed by applicable financial reporting framework is simple. Okay, if the method is simple, then estimation uncertainty will be less. Model used is well known for everyone. Okay, in these situations, the estimation uncertainty will be very much low. Next, high estimation uncertainty. If estimates that are highly dependent upon judgment, that is subjectivity. Next, estimates relating to outcome of a litigation, this involves high estimation uncertainty. Fair value accounting estimate, for which highly specialized entity developer model is used. Okay, complex model you are using, complex method you are using for making estimate, then also high estimation uncertainty. Fair value accounting estimate of financial instruments not publicly traded. Okay, unlisted entities financial instruments you want to value. In such a situation also, the estimation uncertainty will be very high. Auditor shall determine whether in the auditor's judgment any of those accounting estimates having high estimation uncertainty give rise to significant risk. Okay, auditor needs to determine whether any of this leads to significant risk. Next, accounting estimates involving significant risks. If at all accounting estimates involve significant risk, then auditor for such significant risks, he should evaluate the following. What are they? Let's see. For accounting estimates involving significant risk, okay, if auditor feels that for any accounting estimate there is a significant, that means high risk involved, then he should evaluate how management considered alternate assumptions and why it has rejected them. Okay, whether management has considered alternate assumptions for making this estimate, and if they have rejected those assumptions, why they have rejected. Auditor needs to evaluate this, whether significant assumptions used by management are reasonable. Next, management's intent and ability to carry out specific action in order to reduce the estimation uncertainty, whether management has proposed any action to carry out. If yes, what is the management's intent and ability to carry out that particular action? Let's say for example, management or the company is having debtors. There are 15 debtors. From these 15 debtors, from some 20 crore is receivable. Now out of these 15 debtors, 10 debtors have become bankrupt. They are not giving money to the entity, and these 10 debtors own some 9 crore to the entity. Now if you see here, 9 crore provision has to be made for doubtful debts, but management is saying that of these 10 debtors, we will make recovery actions very much with respect to 5 debtors, and we are having confidence that we can recover an amount of 5 crores out of these 9 crores from the debtors based on our actions that we will perform. Now in this situation, management provided only 4 crore as provision. Now here auditor has to verify what is the management's intent and ability to carry out the specific action that the management has proposed, whether management will be able to recover the 5 crores or not. Auditor needs to evaluate. Okay, Next, risk assessment procedures with respect to accounting estimates. See, auditor shall perform certain risk assessment procedures. Basically, risk assessment procedure involves understanding the item and also inquiring with the management with respect to various aspects. If you see here, auditor shall obtain understanding of the following. What is the requirement of applicable financial reporting framework relevant to accounting estimate? Okay, how applicable financial reporting framework is asking to value the accounting estimate, whether it has given any method. Auditor needs to understand it. And how management identifies transactions and events that may give rise to the need for accounting estimates. Okay, how the management has identified that this transaction will require accounting estimate. Auditor needs to understand that. And changes in the circumstances may also give rise to the need for accounting estimate. Inquiries of management about changes in circumstances may include whether entity has engaged in new types of transactions. Okay, auditor needs to inquire with the management whether entity has entered into new transactions. If new transactions are entered, whether estimation is involved for such a new transaction. Okay, this is risk assessment procedure auditor is performing. Terms of transactions have changed. Okay, whether there have been any change in the terms of transaction. Accounting policy relating to accounting estimates have changed. Okay, whether the accounting policy that you have followed for accounting estimates have changed. Next, regulatory or other changes. Okay, whether there has been any change in regulatory or any other aspect. Next, new conditions or events that are requiring accounting estimate. So auditor will ask the management whether any of these aspects has occurred. This is a risk assessment procedure that the auditor is performing. Now, how management makes accounting estimates. Auditor should also understand what procedure, what method the management is following for making accounting estimates, and from where it is taking the data required for accounting estimates, and the consistency and completeness of data, and the assumptions used by the management. All this auditor will understand. See, what method the management is using, relevant controls that the management has implemented, and assumptions underlying the accounting estimate, what assumptions the management is using, change in the method from previous period. Okay, whether there has been any change in the method that is followed by the management when compared to the prior period, how management has assessed the effect of estimation uncertainty, and whether management has used any expert for making the accounting estimate. All these auditor will understand. All these auditor will inquire from the management. So by doing all this, auditor will come to a conclusion with respect to the risk of material misstatement in accounting estimate. Now, after calculating the risk of material misstatement, auditor will design his audit procedures, right, with respect to accounting estimate. Now here, in this, auditor should also evaluate prior period accounting estimates. Why auditor should evaluate prior period accounting estimates? Because management, they would have made certain estimations even in the prior period also, and auditor is auditing current period. Now from prior period to current period, those estimations, actual amounts would have occurred, right? With respect to some items, actual amounts would have occurred. Let's say, for example, in the prior period, management has made an estimation that for the next year, warranty claims would be some 50 lakh rupees, whereas auditor is auditing in the current year. Now, in the current year means the period has already completed, 1 year period completed. So, in that one year period, how much claims have occurred? 60 lakh claim have occurred, but management has estimated only 50 lakh. So, there is a 10 lakh additional claim. So, by this, auditor will obtain evidence with respect to the estimations that the management is making, whether management is making correct estimations or not, and whether there is estimation uncertainty in the estimations that the management is making. With respect to all this, auditor can obtain evidence, actual evidence, by evaluating the prior period accounting estimates and comparing those prior period accounting estimates with the actual figures that has occurred in the current year. Okay. Next, responses to assess the risk of material misstatement. So what responses auditor will perform with respect to assess risk of material misstatement? Auditor shall determine whether management has appropriately applied the requirements of applicable financial reporting framework. Okay, the first procedure that the auditor will perform is he will see whether the requirements of applicable financial reporting framework has been actually properly applied by management or not. Next, methods have been applied consistently. Okay, the methods that the management is using for making accounting estimates are consistently applied from the previous year or not. Next, test check the data used. You have to once test check the data that has been used for making the accounting estimates. Next, events occurring up to the date of the auditor's report provide audit evidence regarding accounting estimate. You have to see that also. And consider the source, relevance, reliability and completeness of external data. Okay, whether the data that is being used for the purpose of making accounting estimate is consistent, reliable, complete, and you should also see the source from which the data is obtained. And finally, if you want, you can also recalculate the accounting estimate. This is also one of the further audit procedure that you can perform with respect to the accounting estimate. So these are the responses that the auditor can design with respect to accounting estimates. Okay, these are nothing but procedures that the auditor will perform. Okay, so by this essay, revision of essay 540 is completed.